Hello, hello. What's going on, everyone? Hello, hello. Hey, Dan, Sasha, Clay, Michelle,
Ooh.
everyone.
And all right, bro. Well, yeah, when you're done there, if you want to stop later, then later, bro. We'll be in touch. Take some money.
How are
There is the
you?
man.
Hello, Dan. Hello, Matt. Matt's running the session tonight, as always. You guys like Matt? So here he is again, the man of the hour, the real estate mogul. Elia, Carlos, Tracy. What's going on, team? Good to have you all here tonight, as always.
Hi. Say it again. Hi.
Hello. Hello, hello.
Are we going to be looking at Section 8 stuff tonight, Matisse?
Ooh, that's a question for Matt. Matt, what are we covering tonight?
We are, yes.
That's what I want.
Yeah. And if we have time, I might be able to cover some tax slides. I know we had some tax questions, some funding questions. What's going on, Carlos? Yes, sir. So we're going to be able to cover a few things tonight. I know Matt has his slides. Pierre, the co-founder, might be joining us as well. But you're on mute, Matt. Want to get started. I think we'll wait another 2 minutes. You might want to make yourself pin yourself.
Okay.
Yeah. Yeah, so we'll wait a couple minutes. If anybody has any questions, we can start with that. Matt's here. We're just waiting for a couple more minutes for people to join. It's already 7:04.
Are there any Jacksonville, Florida properties going on?
For rents, Jacksonville, Florida, yes, there are. Jacksonville, we're not really too focused on just because it's a little light on the rental side in terms of the rental market. In Jacksonville, not Jackson, Mississippi. We're talking about Jackson, Florida. It's a little light on the rentals, and the purchase price is typically above 100,000 for a 3 bedroom plus. So we kind of shy away from it. In Jackson, Mississippi, you can get a 3 bedroom plus for half the price, 50,000. So just the economics for the same amount of rent. So the economics just make more sense in Jackson, Mississippi, rather than Jacksonville. But we definitely have those if you are looking for that specific area. But Matthew, the floor is yours. I think, yeah, you can start with your presentation, unless if you want me to present first and just go over a few slides quickly.
Up to you, boss man. Whatever you want to do.
I would say no. You go ahead. Go ahead. Yeah, my slides are more for I could do
Okay.
it next week.
Okay. Okay. I never know how long or how short these are gonna go. So if there's time left over.
Yeah. So
Okay.
plan.
Awesome. Well, thank you guys so much for hopping on the call tonight. I know some of you are new, some of you already know me. I'm going to be super brief with my introduction. Been working with GWP for about
A year.
seven,
Getting
huh?
up to a year now.
Getting up to a year. I feel like every session
A
it's
month.
another month. Uh, 7, 8 months now, coming up to a year. And but before I started working with GWP, and by the way, I'm just one of the acquisitions agents with them, meaning I'm one of the guys that are underwriting the deals, contracting the deals, working with the contractor, setting the lender up, just working with you guys during the contracting period, during the due diligence, and then up into the point of closing, and then of course helping on the back end with dispositions as well.
Mhm.
But before I started working with GWP, I was actually doing my own flips, doing my own rentals, and kind of have a diverse background in all kinds of different strategies, such as short-term rentals and just rentals in general, long-term, mid-term rentals, obviously fix and flipping, multifamily, creative financing strategies. I just kind of wanted to indulge myself into everything real estate just to learn it all and to have a very diverse tool belt, if you will. Um, so that's why I wanted to join GWP, just because I love the vision of the company. I love the idea of consulting, and that's kind of like my way of giving back in a way of consulting and teaching others how to do the same thing. But I still do flips on the side. I still do rentals on the side as well. But that's my background. I also work for banks doing broker price opinions. So that's something cool to have on my resume as well. I actually work for the banks and do kind of like an appraisal for them on properties that they're either looking to buy for themselves or just looking to do a loan on. So that's pretty cool. Without further ado, I'm gonna get into the presentation here. Just like last week, I worked really hard on this presentation, guys, so don't make fun of it. And I didn't have as much photos as I did last time. I was kind of in a rush, but the content's still in there and the fundamentals of what we're talking about is still very good. So let me share my screen here. Give me a moment. Okay. Yes, no, can you see it?
Yes.
Yes, sir.
Bravo. Okay. Um, man, how do I get rid of this top bar?
Yeah, we got some exciting stuff to cover. I think I know where this is going. It's a it's a strategy, a creative strategy of purchase and turnkey that we want to bring to the
Yeah.
WP investors. But yeah, Matt, I'll let you lead the way.
All right. So the topic tonight is going to be BRRRR versus turnkey. When each strategy wins, how to choose the right strategy based upon capital, risk, and goals. And I decided to choose this picture here. By the way, craftsman houses are my favorite types of architecture and houses. I don't know what it is. I love craftsman houses. I think they're so cool. Um, but this is the only photo that I have for the slides. I know it's a little boring just because in the last presentation I had photos for every single one. But anyways, so the call is going to be structured this way. I like to have a kind of like an index or an overview of the call for tonight. So we're going to talk about strategy overview. We're going to deep dive into each strategy. So BRRRR and then buying turnkey, side side by side comparison when each strategy wins and what it would look like based upon the different goals and interests of our investors. And then I'm going to leave a little bit of time left over for question and answer. Good deal?
Yep.
All right, good
Sounds
deal.
good.
And by the way, these are t tonight I'm going to be talking specifically about our Jackson deals, but it these BRRRR strategies and obviously turnkey doesn't just apply to Jackson, Mississippi deals. If you guys are doing your own deals on the side, obviously, if you guys have done BRRRR turnkey deals before, it applies to every single market and every single area. But we do focus on Jackson, Mississippi, and this is where the majority of our business is right now. Part one strategy overview. So, very simply, if you guys aren't aware of this strategy, all BRRRR stands for is buy, rent, or sorry, buy, rehab, rent, refinance, repeat. Okay? Very simply. So, we're buying distressed properties, we're putting in construction, we're adding value, right? We're buying it at a discounted price because it is distressed. Mainly it's distressed because the could be a variety. I've hundreds of different reasons, and we still buy property today, and I feel like there's still new reasons that I discover with why homeowners are wanting to sell their property. Main ones are going to be that obviously the sellers need the cash. They're moving, they're leaving somewhere. They can't afford the mortgage payments. They can't afford maintenance on the house. They're hoarders. They're deceased. Heirs inherited the property. Foreclosure. There are so many different reasons, and there's so many different types of distressed properties out there. And those are going to be the properties where we're buying, where we're utilizing the BRRRR strategy because the next R is rehab, which we're adding value to these properties. So once we buy them at a discounted rate, and by the way, the prices that we're buying these properties for might seem very, very, very low. Some of these properties we're buying at 20, 30, $40,000, which is crazy to me. But those are the prices in Jackson, Mississippi, and those are the prices that these homeowners are content with taking, or else no one else would buy their property. Obviously, a bank's not going to buy their, or a bank's not going to finance their property. So investors like us are essentially helping these homeowners sell their property to somebody who's willing to pay cash for them. We're adding value to these properties through extensive renovations. Most of the time, we're doing full renovations, including all the major systems, which the big five is going to be the most important, which is, and these five make up a house. It's foundation, roof, um, plumbing, electric, and air conditioning, right? Those are the major systems of a house, and then everything else is going to be mainly cosmetic, such as kitchen upgrades, bathroom upgrades, flooring, paint, exterior work, landscaping, etc. Okay. Most of the time with these properties, we're doing pretty much everything. Sometimes the roof will be new and then we'll just do the AC. But in order for us to buy these and add extensive value is by kitchen renovations, bathroom renovations, flooring, paint, roof, and AC. These are what's going to bring up the value of the house extensively. And then, of course, we're renting these out to Section 8 tenants because we're trying to meet the demand of the market in Jackson, Mississippi. I think last time on our call, we said there was about 5,000 people, 5,000 vouchers waiting to be fulfilled through Section 8. So there's a ton of demand in Jackson, Mississippi. And then once we fill it with a tenant, we're refinancing the property, and then you're just repeating that, right? You're just basically recycling your cash, which we'll get into. We'll get into the refinance part and the loan part a little bit more in the next slide. So, but the core idea I want you guys to understand with this strategy is you're forcing the equity, right? And then you're recycling the capital. That's the most important part. Okay? And by the way, if you guys have any questions whatsoever, please stop me. I don't want you, unless you want to write it down for the end, but I don't want to talk the whole time if you guys have questions. On the other hand,
Well,
yep, yeah.
I've got a question on Section 8. When we get those with this focus on this area and turning these rentals into Section 8s, um, do we have like we do? I mean, I'm doing one flip right now, and GWP has done such a good job of basically doing everything. I mean, they manage everything and stuff. Is it going to be that kind of a thing where I can just kind of keep an eye on it, and sign
Yeah.
papers and make decisions and stuff like that? So I don't have to get in there and find a contractor, find somebody to rent it or manage it, take phone calls in the middle of the night when there's a flood or something. Is that how it's set up?
Mm-hmm.
So the
Correct. And
GW,
yes, that is, I think we have another client, Ilya on the call. Ilya, are you here? Who's currently in Jackson on a deal. I'm not sure if he's hopped off or not. Um,
Some, maybe not.
Ilya, if you're here.
I don't think he's here. I'm looking in the.
Oh, yeah, I would have wished to have him share his experience, but no, it's pretty much the same. You're just signing, you're closing the property remotely, and then we have our own property manager now, on the ground, who manages all the tenant placement. We don't charge for tenant placement. It's just 10% of rents. Her name is Adrian, and we manage it all internally within the door loop software. So she's in charge. As soon as the property's ready for rent, we're posting these properties on Zillow, affordable housing. We're working with the local authority of Jackson, Mississippi, and all of that process is done remotely. And yeah, we're getting your properties up for rent. It's the same process, except that instead of selling the property, you're refinancing, you're holding it, which is going to create a tax benefit for you as the investor on that property. And then yeah, you receive the checks every month from either the government, if it's non-Section 8 tenants that we're placing inside of properties, we receive the funds because sometimes they give it via cash, Zelle, whatever, and then we distribute it to you. But if it's Section 8 tenants, it goes straight to you, paid for by the government, and then you have to pay your own mortgage and things like that. That's the only work that needs to be done, is just treasury moving money around to make sure things are paid on time, or you can just have it on auto debit.
Marquez, I have a question.
Yes, Carlos. I know you're also getting on a Section 8 flip.
What's the ideal holding time on these properties?
It's up to you as the investor. You're gonna, are you looking to do a cost segregation study on it to get a tax benefit?
I was thinking to hold these properties for 2-3 years and then just liquidate, sell.
You can because the market will go up. A lot of what I would recommend is just hold these properties until it makes sense to sell. If someone's offering you top dollar, it would make sense to sell. Especially hold these properties the next 2 to 3 years. We're bringing the market up anyways, because with NGWP, we're buying so much just in one area that the market's automatically going up. And we're forcing the demand, just in one area. Renovated everything, but also Jackson itself, they're doing a lot of infrastructure work where the property prices, not just from us, but because we've been in just Jackson alone, self-investing for 4 years in Jackson. It's just for the same homes that we're buying now for 20, 40, 50. They used to go for 10, 5 to 15,000. So the market is going up. Yeah, so it's up to you if you want to sell, you want to liquidate, cool. You want to hold, just refinance again in a few years, you can as well. It's up to you.
All right. The reason why I'm asking this is because the company that I'm working with to do the financing, the 0% financing for 12 to 18 months. We talked about this before. When you refi the property, you pull the money out, pay off the car, and then just get another one. Get another property for, and then fix it and then do it again. And I can do this in 12 to 18 months. We can do this 3 to 4 times.
Correct. Yes. It's a lot quicker. These types of deals are a lot quicker. Obviously, it's typically less profit than fix and flips. Matt, I don't want to take away from your presentation because this is gonna answer your question and answers. But what's your question, Carlos? Yes, you can repeat this cycle multiple times and apply for new credit cards. You won't be able to use the same credit cards. You'd have to reapply and then you reuse more of those funds again. If you are using credit card money, if you're using your own funds, you just reuse the same capital at all times.
Okay.
Mm-hmm.
All right. Thanks.
For the 0% rate, financing that you just talked about, is that the Amex and those credit cards? Is that what we're talking about?
Yeah, that's American Express, Chase, Bank of America. It's getting you guys that capital that you need for these deals, and then Either in this case, in your case, Dan, it's waiting for the sale of the property to pay it off. For Carlos here in Jackson, it's refinancing once the renovations are complete.
Yeah.
So, but Matt's, I'll let you take the floor again, but hopefully Carlos and then that answers your question and anybody else as well.
I'd be surprised if you guys had questions at the end of this. Hopefully, I just through this, I can answer all the questions. If you guys have any left over,
It'd be
at the
great.
end, of course, I can answer it. But I promise I'm going to touch on everything.
Let's go.
Okay, so so that makes sense, right? Hopefully, the BRRRR
Mhm.
strategy.
Yes.
Okay, so next strategy would be almost the complete opposite. You're buying these properties already fully renovated. They are rental ready as they stand right now. They might need a little bit of upgrades to make Section 8 compliant, but it's very minimal. And the tenant might actually already be in the property or quickly placed since it is already renovated and turnkey. And then in opposing to the burst strategy, you'd be cash flowing immediately, right? Right when you close on the property, if the tenant's already in there, you'd be making money right away. If not, it might take a couple weeks to fill it with the tenant. You'd still be cash flowing right away. So the core idea with this strategy would just be stability, simplicity, and I'll show you later on in my presentation. I believe there's a balance to a good blend between the both of these, but we'll talk about that in a bit. Okay, so deep diving more into each strategy, let's talk about BRRRR first. So what it actually looks like and what I mentioned on the beginning slides was you're acquiring these below market value, usually depending on how bad the house needs renovations. You sometimes 50, 40, 30% of the market value. Since the margin on these properties is not a whole lot, we can buy these at 40, 30% of value at times just because it might need a lot more renovation than most. Second thing I mentioned was we're renovating the Section 8 standards. Section 8 has standards. You can't just throw paint on the walls and expect Section 8, which is essentially a form of government that's paying the rent, HUD, to allow their tenant to stay at a property that just has paint but is not compliant up to certain codes that they want to see the property being under. Um, Next thing would be you're leasing to that tenant, right? You're refinancing based upon the new appraised value because you're adding value to these properties. So I'm going to talk about that right now. I'm going to touch on that. So when we're buying the property, there are two different avenues you can take with the BRRRR strategy. You can buy using cash, which personally I recommend doing because you're saving a lot more money on closing costs in loan costs. If not, you can still leverage hard money, which just think of that as and a lot of you guys are doing fix and flips right now. It's very similar to how that would work. You're buying it as if you're buying a fix and flip, right? You're maybe getting 85, 90% of the purchase price, 100% of the renovation. You're going to be paying loan costs. It's going to be substantially less money, maybe 5, 10% of both the purchase and the renovation than you would in comparison just buying the properties all cash. But of course, you're going to be paying interest on that money. You're going to be paying loan costs on that money. So that's why I say the cash avenue's better to buy the property. And then after 2 to 3 months, you're refinancing. So typically with these properties, we're seeing anywhere from 2 to 3 to 4 weeks, depending upon the scope of work, for these properties to be completed with renovation. 4 weeks would be the house needs absolutely everything. 2 weeks, it might just need some cosmetic work. And then if you're going to want to fill the tenant or refinance first, doesn't matter. If you fill the tenant first, probably going to take 2 to 3 weeks to fill, and then maybe another 2 to 3 weeks to refinance. So total is going to be about 2 to 3 months before you refinance. how the refinance process works is once you put in renovations, right, you're adding value to the property. So now the bank is looking at that property as more valuable than when you purchased it because of the renovations you put into the property. So if you're buying cash for the property, let's just use that example. Let's just say the purchase price. I wish I had numbers here on the side so you guys could see. Silly me, I didn't add any kind of examples, but let's just make it very simple. And oh wait, I think I do have an
No,
example.
yeah, you can.
I do have an example. There we
Woo!
go.
Yeah,
I
in
just made
worst
this
case, we'll
slide.
take
I
it
just
off
made
our
this.
site as
I do have
well.
an example. Praise God.
Let's
All
go.
right. So purchase. Here's a perfect example. Purchase $70,000. Rehab $30,000. Your total all-in costs. Let's just exclude closing costs for the sake of this example. Total all-in cost is $100,000. Because of the renovations, the appraised value or the after repair value is $140,000. So a bank will look at that property and say, okay, this property is worth $140,000. They'll send their appraiser out and they'll appraise the property. Banks, depending upon the property, the area, and just the bank, will give you a range of loan to values. That's going to be just how much they'll give you based upon the after repair value. Sometimes they'll give you only 70%. On commercial deals, they'll actually give you closer to 65% because it's a lot of risk for them. But we're seeing anywhere from 70 to 80% loan to value in a moving scale. And it's going to depend on a couple of different factors like your guys' credit score, liquidity, what else? The actual appraised value of the house. Usually, if the after repair value is over $100,000, they're gonna give you closer to 80%. If it's under $100,000, let's just say $95,000 is the after repair slash appraised value, they're probably gonna give you anywhere from 75 to maybe 77% loan to value. But for this example, let's just say because of this, they're giving you 75%. That means your loan, the bank is willing to lend you $105,000. That means all of your capital comes back to you, plus you're making an extra $5,000 on top of that. That's that's the power of the BRRRR strategy right there. Is you're getting all your capital back by adding value, plus you might make a little bit more. In this example, you're making $5,000. It's called a cash out refinance. Okay? That's how that works. It's very powerful and it was very, 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 very common back in the day when it was just everybody was doing it because of how low prices were. It's a lot tougher to do nowadays, but if you're buying property super deep, you can, especially in Jackson, you can most of the time get away with making money on the refinance.
Question for you, Matthew.
Yes.
What if you have credit cards on top of that loan?
That's a really good question. I think that's so most investors ask that question. The idea with, and Matisse, correct me if I'm wrong, the idea with this is to
Yeah.
stack these properties, right? Because if the idea is you're making $5,000 from the refinance, plus you might be making anywhere from $200 to $300 in cash flow a month, that means you have no more money left in the deal. And whatever cash flow you're making and whatever refinance profit you have, you can put towards paying those credit cards. So the idea is stacking these properties to 3 to 4 to 5. And
The goal, to add, I mean, the goal, you were asking, what if, I mean, the goal is you use the credit card or your own cash to buy the deal to cover the renovation, cover the purchase, and then refinance with a DSCR loan, which is a mortgage for rental property. You're going to be left with either there won't be any money coming back, or it'll be like 5 to 15,000. That's in a form of the additional difference between what you paid and what you're receiving back in the loan.
Can I add something to that, Matis?
Say that again, Carlos?
Can I add something to that?
Yes.
basically when you refi the property, you have enough cash back to pay off the cards.
That you're gonna have, yes, that back plus additional funds
Yes.
on top, and that's profit. It's not considered profit, but you can view it as profit because it's additionally you put in this case you purchase plus rehab. You put in 100,000, you pulled out 105. 5,000 would be the difference.
Yep.
You got an additional 5,000. It's not technically profit because you still have to pay it back, but you're not the one paying it back. The tenant's the one covering the rent, whilst you're holding an asset that's going to appreciate in value, especially in that area across the next 2 to 3 to 5 years.
Yes.
So, Matisse, did you just say that the bank will loan you on a DSCR basis rather than your personal credit for the
Correct.
single family home? For a
Correct.
single family. Yeah. Wow.
Yes.
I didn't know that.
It's a debt service coverage ratio. You can look it up on ChatGPT online. DICR
Right.
loan, very common with lenders. They look at the deal, they look at the renter. And with our lenders, as Carlos, you're going to see, you don't even need a tenant to refinance. You refinance as soon as the property's done and you have an appraisal for the property.
Yeah, I thought that was only for commercial real estate,
No,
5
sir. No,
units
sir.
and above.
And the reason why we do it
Yeah.
for one single family rather than just buying multifamily is in the unit level, Section 8 pays more for rent. And
Yeah.
they've got a choice. Is it better to
Yeah.
have with a voucher, you can rent an apartment, you can rent a house. It's better. You're always going to pick the house, right? So that's why it's
Mhm.
more ideal to have single family.
Okay.
And we do the renovation so we don't have issues when renting out the properties. And Tim, it's called DSCR loan, debt service coverage ratio loan,
Hmm.
DSCR loan. It's a mortgage for a rental property.
Matisse and Andrew, this is Luz. I would like
Hello.
to. Hi. Um, I was trying to do this by myself, and thanks to the Lord, I found you guys. But I saw previously you can use even artificial intelligence to do all these calculations, where you are just not having the purchase in the hard rehab, but any interest or additional cost that you may have. So you can calculate since the beginning what is the real cost of the project, and that is really helpful. So because sometimes, yeah, you can be a little under, but doesn't matter. It's gonna be a good deal anyway, but you need to include all the
Fees.
you say variances, interest, and expenses that you may have.
Mhm.
This is like a very good example that Andrew is giving us, and it's like a basic thing, but you may have the case where you need to add more things. And if you guys are using the artificial intelligence, that will help you a lot with those calculations.
AI, like no, we use a Manus for the few tools that we have.
Mm-hmm.
A very good point, Matt, and yeah, hopefully that answers your question, Dan. And
Mm-hmm.
Thank you.
I think it was Carlos as well, and Tim.
Yeah, because if you just had, let's just say for example, you paid for cash for this property and your credit you owed $100,000 on credit card. That's just for an example. Um, Once you get that back at the refinance, you can pay that back, and then you'd have the 5,000 left over plus the cash flow. Or you can just keep recycling the money, which is the idea of utilizing this strategy, right? Pull out all of your capital and repeat. So that would be the last thing. That would be the last R. You're repeating the process because you have all of your capital back, and then you're just redoing this over and over again. Okay? Everybody understand the example?
Yes.
Yep. Okay, great. Okay. Why BRRRR is attractive and some of the risks that it's involved. I've said a number of times already, you're recycling your capital using this strategy. since you are recycling your capital, you're not going to tie up your capital as quickly as you would buying turnkey. So you're going to build your portfolio a lot quicker that way. And then it's just going to be based upon deal flow. Higher long-term ROI since you're becoming a value add investor by utilizing this strategy. And then, of course, creating forced appreciation that way as well. With attractiveness comes risk as well. So, I mean, there's just a number of risks, just like with any kind of investment or real estate investment in general, especially if you're adding construction to the mix. Rehab overruns, which um, we kind of combat all these risks, but let me just go through each one. Rehab, overruns, contractor issues, delays, appraisal risk, refinance risk, holding costs, right? So these are just some of the risks. If the execution is sloppy, then the returns aren't there, especially on these deals where margins are thin. We want to make sure that we're making the most and doing everything correctly and very, 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 very efficiently. So with the rehab overruns, it happens. Happens a lot in real estate in general. Obviously, the way we combat this is the relationships we build with contractors. We know their pricing, we know what they're going to charge us for X, Y, and Z. So that's a way that we try to combat that, of course. The contractors that we use, we have built up relationships with over the years. We're actually having more of our team members flock to Jackson, Mississippi, because that's kind of where we're buying. Since we're buying a lot more properties, we're going to need a lot more of our contractors and our teams there. Um, Delays, of course, appraisal risk, refinance risk. These are all just numbers. We have an in-house appraiser that we use to appraise all of these properties who know the market, who who go to the properties in person to praise the value of the house. Refinance risk, of course, that's the same thing. Holding costs as well. You know, what are the exact holding costs? What are the interest, the taxes, the insurance? We want to make sure that we have all this in order even before we buy, because even $100, $200 off, that's going to cut into your guys' cash flow. All right, so it's very important that we get these metrics very, very right, and we're very efficient in everything that we do with dealing with these properties.
Matthew, I have a question on that.
Yes.
Uh, in regards to the rental vouchers,
Hmm.
there's there's enough tenants to rent these properties.
What was that?
Is there enough tenants to rent these properties?
Is there enough tenants to rent these properties?
Yes.
Yeah, at the beginning of the call, I said there's about Matisse actually visited Jackson not too long ago. He went to I think the county clerk's office, and they said they have about 5,000 vouchers in need of in demand,
Rental.
meaning 5,000 people that they need to house. And with Jackson, Mississippi, I will say it is more of a C class area, but that's really good for an investment standpoint because that means it's cash flow. You have steady tenants. Um, so with those tenants, they're looking for good properties to live in. Most of the properties in those areas are owned by either very tired landlords or institutional buyers who don't really care about the property. So I mentioned on our call last week that these tenants are looking for somewhere nice to stay with a responsive landlord, with somebody who's going to be attentive to any kind of maintenance request or any kind of nightly calls that they have. Um, so a lot of demand in this market is unquestionable.
Okay, thanks.
Yeah.
How are we covering the 24-hour a day, kind of management of these things?
What was that?
You said that we want attentive landlords to answer calls in the middle of the night and stuff. How do we cover that? Do we have a VA that does that or what?
We have property management. So property management
Okay,
is going to be taking those calls, and so those will be boots on the ground, so you guys don't have to. You guys are more than
right.
welcome to manage the property yourselves if you don't want to, because it is about 10% of the effective gross income that they're taking every month. Or you can just
Worth it for the
utilize,
headaches you're not dealing with.
yeah,
I'll tell you that.
yeah, especially if you guys are, I mean, I personally manage all my properties. It's not as difficult as you would think, but I mean, once you start building them up, 1000% you're going to want to get property management in place, and I would definitely recommend it, especially if you're not local.
Yeah, I know you said it before, but I would like to, if we have one, I'd like a list of the departments or the people with GWP that handle each of these areas. You
Yes,
know, the
sir.
rehab, the all that stuff. Do we have a
So,
list of those?
so the best thing I can give you right now, I mean, we have an org chart internally with all the different divisions, but just yeah, bird's eye view on some of the team members. And goes to show Matt's not even on we got a lot of new team members, salary based positions and performance based positions. But mainly myself, Pierre, Michael, your funder, who's there at any time if you guys need funding help. Marla, our enrolled agent. Ray, one of our underwriters, and here's Adrian, the property manager in Jackson. She's handled over 300 units in her prior position. She joined GWP. She's full time with us. She manages all of our clients' property there. And no, she's an absolute killer and
Good.
handles the
Uh,
rest.
it, this is at generationalwealthplan.org. We can
That's
go
on
look at
our
that
main
anytime we
website.
want.
Yeah, that's on our main website, Dan. If you want
Okay, yeah, because I'm already familiar with these people and I have grown to trust them. They are just
to.
we
Yes,
just
sir.
we've done a you've done a good job of getting those people in place, and they do
I
good
know
work.
they work very hard and they're doing great work for everyone. So we appreciate them. And Matt's
Yeah,
not even on the side. Matt needs to be added. That's you're reminding me, Dan, to add him
yeah.
as the coach. But Matt, go ahead. Yeah, I appreciate it.
All right. Love the questions, guys. All right. Next. Okay. So who is BRRRR for? Mainly, these are going to be for people who want to scale very quickly, who want to build up a portfolio very quickly of three, four, five, six units. And when I say units, I mean houses in this case. We do come across multifamily buildings as well. Not as often, but we do come across those as well. Uh, Investors comfortable with short-term complexity, meaning between that 2 to 3 month gap with the renovation, the filling with the tenant, the refinance. There's a lot involved in
Señor
that short
Diaz,
amount of time. What was that?
you ate your dinner?
What was that?
My bad, I'm sorry.
Oh, all good. There's a lot involved in that 2 to 3 month time, and just with the renovation again with the film with the tenant. So sometimes people don't stomach that. They don't want to deal with that. They rather turnkey. So there is that timeline you just have to get past to rent the property to start building up the cash flow. Investors with liquidity and patience, again, not always necessary since a lot of you guys are utilizing the credit cards and the hard money loan in the initial phase. Patient, again, with that 2 to 3 month period. And then investors focused on long-term wealth building. This is going to be the fastest way to build wealth very, very, very quickly is doing this strategy, just recycling your capital over and over and over and over again. Not to say that turnkey investing isn't the same way, but it is a lot quicker with the value add strategy. Okay. Next strategy we're going to
I got.
cover. What was that?
I have a couple questions.
Yeah.
Well, I forgot where we actually see the deals that you have. If it's a turnkey deal, if it's a BRRRR deal or something, where do we see those? If we want to see what's available for, investment, you guys find them and then you post them
Right.
somewhere, right?
Yes, we will send them
I
out
forgot
to
where that is.
individual group chats with you guys. So if we know you guys are
Okay.
looking for something,
Yeah.
you'll be the first person we go to about it. Some people don't want to deal with that. They just want to focus upon what they're working on and we won't send it to
Yeah.
them. So just be vocal about what you're looking for and we'll start sending you stuff.
Okay, that's very good. And the other thing is, do we have some kind of a, I guess it's referred to as an underwriter spreadsheet or something to kind of look at the deal and say, this is what I should expect to put in, and this is how much I'm going to get out.
Yeah.
Yep. It's called a profit analysis. We actually have it. It's the way we introduce the deal to you guys. And it's going to have all the numbers on it from rent to all the operating expenses to your closing costs to your purchase price. It's going to have everything on it. And so
So you've done that already. We can just ask for it. Yeah.
yeah, we'll send that to you guys. So we'll say,
Okay.
hey, um, hey Dan, that's my son's name, Dan. Hey Dan, we have a deal for you. Here's the profit analysis. And then you look it over. If it works for you, great. We'll put you on. If not, we move on to the next person. But usually these deals are going pretty quick too.
Yeah. Yeah. Well, I'll just get active on WhatsApp.
Yes, sir.
Just let us know what you're looking for. We can get very specific too. If you have very specific criteria,
Thank you.
no problem.
And we're gonna have a form as well for it, if it makes it easier for you guys to request them and notify a team of who wants what. We'll have that internally as well, being built out. But yeah, go ahead, Matt.
Yeah. Yeah. Even if you're looking for a brick house, I know some people are very specific with what they want. Brick house, 4 bedroom, 2 bathroom. Um,
Section 8, not Section 8. Well, we'll do it for you guys.
yeah, whatever
Okay.
you want. You come across all
All right.
kinds of properties in Jackson.
Mhm.
All right.
Thank you.
Can I ask you a question about how we split the profits? Because I know when we do fix and flips, it's like an 80-20 split. How
Mhm.
do you guys how does it work on the rent and hold? You guys make the money on the
Oh, yeah, great question, Jerry. On rent, it's 10% of rents, no matter what. Like, because it's a property manager that needs to get paid for that position.
Okay.
For the if it's a BRRRR, like it's first of all our profit share only comes in once you reimburse the program fee. Like we want to make sure you're profitable and you at least
Right.
building some a portfolio first.
Yes.
So that's number one. Let's just say you reimburse it, you made it your profit back, and you're happy. You got some properties, then yeah, it's 20% of whatever the cash out is, like whatever the difference is on the cash out or profit on a fix and flip.
Right. Okay. Because I would definitely have you guys manage it. Because 10%, I would give you 10% to manage it every single day. But
Yeah.
somebody mentioned, oh, if we wanted, we can manage our own properties.
And
Frankly, I think it would be crazy.
We're at the end of the day, we're here to advise, consult. We have a process. We have internal teams, especially in Jackson, that we're scaling up to
Okay.
make quality. But you guys aren't like obliged to go with us in any step of the process. You want to do it your way, we're fine going your way as well. We're just going to advise, hey, this is the way that works for us, and the 700 plus deals that we've done, especially in Pierre and across my career. This is how we've always done it, and this is what works. This is what didn't work. This is what we advise. What do you want to do? We
Yeah,
want
no, listen, I'm in the middle of my first fix and flip, and now I'm about to start my second deal with you guys, which is going to be a hold and rent. And you guys are really great. Your team is really helping me out every step of the way.
Damn, guys, I'm gonna have to collect some more testimonials. What's going on tonight? No,
Yeah,
but
what
I
are you
appreciate
paying
that,
these
Jerry,
guys?
and then
Yeah. All right. Well, thanks.
yes, sir.
All right. So the
Sure.
shoot. Okay, next strategy is just going to be the pretty much the very opposite, turnkey, which is you're buying these properties already renovated or partially, doing minimal work. It already meets Section 8 standards or needs minimal work to get up to Section 8 standards, which there's a whole nother presentation on what Section 8 standards are, and it's not as vast as you think, but it's just making sure the property is basically up to code with everything, right? The roof is a good age. The house is safe. There's nothing that can harm the tenant. There's no exposed wiring or even leaky faucets. There's nothing or leaky pipes. It's just a very nice house, which is great because now you have a house that can last a long time rather than just deferring the maintenance because there are regular inspections with Section 8. Um, tenant placed, they're already in the property or they're quickly placed, and then you cash flow immediately. So very straightforward, just like with any rental that you buy, that's the process. Very basic and generic example, you buy it for 100, you rent it out for 1150, which by the way meets the 1% rule. The 1% rule of investing in rentals is just if the purchase price is 1% of the rent, then that generally means the property is going to cash flow. Not always 100%, but it's just a good rule of thumb for you guys to use. That means annual rent is 13,800, expenses 5,000. So the NOI or net operating income is going to be 8,800, and then your cash yield on that amount is going to be 8% of that. Okay, so very basic, just generic rental.
Wait, question on that. Does Section 8 allow you to raise the rent every year?
Yeah, they do. They do. Yep, they allow you to raise the rent, and they actually anticipate that you're going to raise the rent, so they do, and it can vary. It's just depending on zip code, bed bath count, etc.
And again, you guys managing the property for us, you would let us know when you think it'd be appropriate to raise the rent.
Yeah, absolutely.
We typically raise the rents every year. For Section 8, that you're allowed to raise a maximum like 5% of rents, like 5% every year, typically is the restriction. So there's rent control when you go through Section 8. With market tenants, you can bump that up however you want given Jackson regulation is pretty loose in regards to what you can do. So yeah, if we want to bump it up 20% in a year, 50% a year, we definitely can if market rents go that high. But typically, it's 5% a year that they allow you to increase.
Okay.
So that's extra profit in your guys' pocket every year, on top of the appreciation of the property, on top of getting some nice tax benefits for holding it as well, which is a whole nother conversation that we can have on the next call.
Yep.
Next
And
trip.
then property management has an incentive to raise the rent because they get paid on the effective gross income. So we also have incentive to try and raise the rent as well. Of course, we want to provide affordable asset for somebody to live in, but they're anticipating that most of the time for it to raise by the year.
That cash yield is sometimes referred to as the cap rate, right?
Um, yeah, I think so actually. Yeah. I think you're right about that.
It's the same calculation. Yeah.
Yeah, it is. There you go.
Yeah, NOI, net operating income divided by the property value.
Mm-hmm. Yeah, good catch. Yeah. I usually look at cash on cash return more than cash yield, but it's hard to justify that right now with just the example. So but usually cash and cash return, especially if you're pulling out money, is going to be infinite.
Yeah,
So,
which is why it works so good.
right.
Mhm.
Okay. So why turnkey is attractive in comparison to the BRRRR, immediate income, obviously there's no construction risk, you're just renting it out right away. There's no delays. The returns are very, very predictable. There's not a whole lot of levers you can pull. You know what you're going to get. It's very simple. And the risks involved with that could be overpaying. Most of the time you're not because we're involved and we know where to buy these properties and we have relationships where we can still buy these at a pretty good discount. Lower equity upside. There's no value add creation in there where you're leveraging equity. Less control over renovation quality, right? We're buying these. We don't really know what the the last owner did. So we usually want to have an inspection to just check that the work is good. Market dependency versus forced appreciation. So the reality with these properties is you're paying for convenience, reduced risk, speed, which means lower upside compared to BRRRR. So those are just basic framework of both strategies. Who this is for: busy professionals, passive investors, first-time investors, investors prioritizing stability over scale. The first one doesn't really apply to you guys since we'll be managing it on your guys' behalf. You guys can be as passive as you'd like, but of course, we still want you guys to be involved since you're owning the property. So it's not really counting that, but if you can't really stomach renovations, then this is great for you for a first-time investor. And then on the next slide,
And it just on that last bullet item, if you would, that stability over scale with a turnkey, you're not really, unless you have some extra money for the next one, you're not going to be able to scale, right? Because you're not refinancing and caking anything out to go for the next deal, right?
Correct.
right.
Typically, and this is why, I mean, the Jackson market, I'm not sure if, Matt, you're covering that in additional slides, but we have a way where we're having our clients purchase.
Yes, I'm getting to that.
Okay. I don't want to spoil the beans then. I'll keep my mouth shut, but it's
Told you
coming.
I was
Dan,
getting
it's
to
coming.
everything, man. I've told you.
He packed it up. Yeah, it's going to be a long session tonight.
No, I'm almost
Dan
done.
packed.
I'm almost done.
Matthew,
Uh,
it's loose again. Can I add something?
sure.
That you're saying about the risk. I don't know about the risk with the tenant. If you don't have previous experience, that can be a nightmare and you can lose money with that. So that's why I was also sending here a message talking about managing, because sometimes when you say 10%, oh my gosh, that's so expensive. But then when you see the amount of work that you need to have, the time, you know, and the probabilities of getting the wrong person, you will be happy paying for
Yeah,
the managing. Yeah,
yeah,
that's my comment.
for sure. Especially if you're buying a lot too, because it's hard to manage so many people
Yeah,
at once.
that's right.
Maybe one or two you can get away with managing yourself, but I would say definitely at some point in time you're going to want to.
Let me tell you an additional thing. I even got an audit from the IRS, and I had the opportunity of
Uh-oh.
finding a good auditor, and they were actually giving me some tips. And they give me that advice, especially if you have more than two rentals, it's better to have your own accountant, tax advisor, and your managers. Less
Hmm.
risk.
Yeah,
Mm-hmm.
appreciate that. All right. All right, I'm almost done, guys. Okay, so I want to show you this super quick. This is super interesting. We found a lender who allows us to utilize a certain strategy to where you can actually, if you buy a turnkey deal, still can have um, not too much in the deal. So I'm gonna pop over here and show you guys that real quick.
And then just for a simpler version of that is basically coming into deals with buying a turnkey property with no money down is the structure that it's called.
Right.
Mm-hmm.
Exactly. So this is it right here. Let me just
Sounds a
change.
little crazy, but we've done
Sorry.
it. We do it. We're now implementing that for a lot of GWP clients. As long as they have cash, you don't want it to. It just
Right.
recently got available.
Right. Okay, so this is one of our preferred lenders right here, Wise Capital Solutions. They're more transactional funding, but they also do this strategy that I'm going to tell you about. Okay, so super quick, when we are buying turnkey deals, we were trying to figure out a way where our investors could have the stability of buying something that's turnkey, but then also the strategy utilizing the limited cash out, capital out strategy that's similar to the BRRRR strategy. Okay. So in this instance, we're still buying these properties, even if they're turnkey, at about 70% of value. And which is crazy, but we are. And the reason that that is just because Mississippi is, I'll be honest, it's an overlooked market, especially in Jackson. There's not a whole lot of institutional
No,
buyers.
yeah,
What was
no
that?
hedge fund is telling us that about Jackson. That's for sure.
Right. Yeah, exactly. Exactly. It's kind of an overlooked market. Same with Arkansas. But not a lot of people invest in this market, which is why we're able to buy them at a discounted rate, even if they are turnkey. So for this example in particular, let's just say that the house is worth $100,000. We have the opportunity to buy it at $70,000. Let's just say it doesn't need a whole lot of work. It might need to be filled with a tenant, but currently the owner lives there. And they want to sell very quickly, so they're just looking to sell at a discounted rate, which is 70 grand. Okay. So that's how much they're getting here. Okay. Just for the sake of this, I'm just going to leave this as 0 just to make it easy. This is the wholesaler fee. This is when we work with wholesalers, of course, they're going to get a fee in between that. But just for the sake of this, we'll just leave it as 0 because I don't want to confuse you guys. Um, Number changed. $75,000 is what we agreed to with the seller. Um, we're gonna buy this at 100. Okay, stay with me here. We're going to ask the seller to credit us 25,000 or seller finance $25,000. It doesn't matter. It could be both a seller finance or just a credit. Point is, they're still getting their $75,000. Okay? So they want 75. We're buying it for 100. They're crediting us or seller financing us $25,000. Seller closing costs about 2%, real estate commission about 5%, right? Because the sellers are going to pay the real estate commissions. If there's realtors involved, sometimes there is, sometimes there's not. We're going to go for a loan. We're going to get 80% of $100,000, which keep in mind the house appraised at $100,000 because that's what it's worth. We're just buying it at 75. So we're going to get a loan for $80,000. Our down payment is going to be $20,000. Okay? Stay with me. Closing costs for us as the buyer is going to be $2,000. And let's just say our origination fees for the loan on the loan is going to be about $3,200. So our total cash to close is $25,000 to 200. Okay, so that's how much you guys would need to come up with closing if you were just buying it normally as a turnkey rental. But since we asked the seller for this credit back, that amount is going towards the proceeds, or not the proceeds, but the amount that you would have to close with. So at closing, you're only coming up with $200, which is crazy to think about. But since since these properties are very low priced in Jackson, Mississippi, and rental rates are very high, even if you buy this at $100,000 and get a loan for $100,000 or 80% of $100,000, the deal will still cash flow, right? If this rents out at 1,400 a month, let's just say your expenses for the year are about 5,000. This deal, for this example, will still cash flow, even elevating the price. It's not illegal to do this as long as everybody is aware of this strategy, including the lender, including the seller, including the realtors. It's not illegal. We have our lender who actually incentivizes us to do this. They actually taught us how to do this, which is interesting. So they want us to do deals like this. Um, so that's what essentially helps you have little to no money in these turnkey deals, which is super interesting.
So is that $369 cash flow split between you and me?
This, no. This
Yeah,
this
the
is what you guys
369.
pocket.
That's
This
what we get.
that's what you get.
That's
We take our portion from, well, just the property management takes their portion from sorry. GWP takes their portion from the property management, which is in
okay,
the
part of
extract.
the expenses. Okay. All
Exactly.
right.
Yep. Sorry, I was tongue-tied there for a second. But right, this would be your guys's. That would be cash flow to you
Right. Right.
with $200 in the deal. So super interesting
Awesome.
concept. Super interesting concept. This can also be seller financed. Let's just say it's not in a situation where um, the seller wants to do that for some reason, which they're getting their amount anyway, so I don't know why they wouldn't want to do that. They can still seller finance that amount as well, which you just be paying them percentage based upon their equity, and it would be cash flowing less, but same instance. Well, pretty cool.
Pretty
Pretty
cool.
cool.
Yeah.
So you can buy these even turnkey deals with little to no money in. So more
Yeah.
an incentive there to do that. Um, so yeah. Any questions about that at all?
Yeah, you got to run your credit on these, right?
If you're getting the loan, yes.
Yeah, and if you're buying enough of these, like sometimes within it depends on the lender. They run the same inquiry. They can run the same inquiry within like a free month, maybe 6 months max period. They don't have to pull the same. They don't have to pull your credit more times.
Well, if it's a
So
DSCR loan, they're not going to worry about your credit, right?
they still do. They still do.
Yeah. They
Yeah,
say they do,
it's
but I mean, they do.
they do, but it's not. That's not the decision. That's not the make or break factor. You could have a terrible credit and still pull out some funds, like you do a DSCR loan.
Right. You just might get not as good terms as if you would equal
Hmm.
the credit score.
Yeah, they're going to give you a high interest rate for sure.
Right. Okay. So
Oh,
I'm almost done, guys. Just side by side comparison of the two. And
And the one thing I'd add, just to answer the questions in the chat, someone
oh,
asked about
right.
the. Did someone ask about why is there no less institutional investors like hedge funds in this market? I mean, they still are.
There
I'm
are.
not. There's not no hedge fund. It's still a good market. It's just it's not part of their buy box for most of them. They don't look at Jackson necessarily as one of the markets they're invested in. It doesn't mean that it's not a bet. It's not a good market to invest in. Um, yeah, for us, we're focused on low income housing and get properties that cash flow with some decent appreciation. That's why we're here because you basically pull out all your funds with a BRRRR. They're not doing that. Hedge funds are buying turnkey already, so different strategies.
I'm sorry, I missed the beginning. What does BRRRR stand for?
No worries. Buy, renovate, rent, and refinance, or refinance and
Repeat.
rent,
All
Refinance
right, cool.
repeat.
Thanks.
and
Yep.
repeat.
and
Yep.
repeat
Buy.
and repeat the process to scale a portfolio. Mm-hmm.
Yep. Buy rent rehab. Sorry.
But
Buy rent. Sorry. Buy rehab rent refinance repeat. That's
yeah,
what it is.
Yeah.
or we just call them Section 8 flips because you're kind of flipping your money, getting back, getting some profit. But
Mhm.
yeah, it's a burr. It's just a marketing term. You know, it is what it is. It's a deal. It's a fixed to rent property. Basically, is what you have. But it just
Yeah,
explains the
got it.
steps that you're going through. Mm-hmm.
Yep. Yep. All right. So side by side comparison of both. Capital required. And I'm not going to be talking about the seller carryback. I'm just
Yeah,
going to be talking about.
that is going to need. We're going to need a lot more calls about that. Seller carry back, no money. Well, in this case, it's a buyer carry back, right? Instead of seller carry back.
Well, yeah, the seller credits.
Seller credits.
Yep.
It has to be structured right, with the right lender where everybody knows what's going on. So it's legal,
Mhm.
but it's yeah, we've done correctly. It's a great way to get into a property with none of your own money. Well, with your money inside the deal for 24 hours and getting reimbursed back.
Mhm. All
So
right.
we'll do a future sessions, but go ahead, Matt. Yeah, finish us off.
All right. Almost done, guys. So capital required, BRRRR, high up front, but you're recycling this later. Turnkey, high up front, but staying in the deal. Timeline, like I said in the beginning, you're delayed just because of the refund, the rent, or not the rent. Oh my gosh, it's getting late for me. The
Yeah.
rehab, the rent, and then the refinance. So it's going to take anywhere from 2 to 3 months for people that want more cash flow now. Turnkey is going to be better for them. Risk level, obviously, the BRRRR is going to be higher because there is renovation involved and can vary with the numbers on the appraisal and all kinds of, and just the numbers on the appraisal and whatnot. Turnkey is very stable. The return, obviously, you're going to, with any kind of value add strategy, you're going to make a lot more. And then turnkey, it's very stable. Speed to scale, BRRRR, you're recycling your money, so it's going to be very, very, very quickly. Usually after 2 to 3 months, once you refinance, you can buy the next deal, 2 to 3 months, buy the next deal, and then you could probably buy 4 of these a year if you're consistent. If you want to do it one every 3 months. Turnkey, it's going to be a lot slower. You're going to have your capital tied up, of course. So this is interesting. I have when each strategy wins. Of course, each investor has different goals, different interests, what they desire. So that's why we're talking about both in this session today, because we have a lot of investors in our group. If you want to build a large portfolio, if you want to recycle your capital, if you're okay with that 2 to 3 month buzz period, and if your trust in us is high, then of course BRRRR strategy is going to win all day long. If you want consistency, stability, simplicity, you're more risk adverse, then turnkey is going to be the strategy for you. Next slide. This is an important slide, and this is actually how I invest personally. Um, well, before I mention that, most are going to start with turnkey. They kind of get familiar with the process, especially if it's their first rental, get familiar with the area. They feel like they have a good grasp of the area. Of course, it's different for you guys since you'll be working with us. But usually, most people start with something turnkey that's very stable and they transition into BRRRR and they grow rapidly. The way I invest and the way I believe is the best way to invest is to do that, right? Start with the turnkey, but then transition to BRRRR. But overall, there's something called the barbell strategy, which is super, super interesting. And all kinds of private equity guys and big real estate moguls Doge delve into this type of strategy. Ray Dalio is a big advocate of this strategy and how he invests himself. Basically, it's just the barbell investment strategy is just a portfolio construction method, right? So it's just all kinds of different investment models, not only real estate, but it allocates capital to two extremes, opposite ends of the risk spectrum. Extremely safe, low risk assets with highly speculative, high reward assets, while avoiding the moderate risk middle ground. It's designed to maximize upside potential from high risk investments while securing the portfolio against significant losses using low risk income generated assets. So it's really just about diversification. Maybe over time, you start buying turnkey, you go to BRRRR, you buy another BRRRR, but then you go back to turnkey to kind of um, balance out your portfolio a bit, but the idea is to have a mix of both, right? Turnkey, BRRRR, and then God forbid if anything happens with the renovation on the BRRRR or the cash flow and didn't meet the certain metrics, you at least have that more stable asset to balance it out. But eventually you're going to have, if you keep buying these, you're going to have a BRRRR that's going to do exceptionally well and it's going to blow all the other deals out of proportion. Um, but the idea is just to kind of balance your portfolio, especially if you're buying a lot of these deals. And of course, the name of the game is recycling your capital over time as
Exactly.
well. So I just thought that was cool to add towards the end because
Absolutely.
I heavily believe in this idea for sure.
Hmm.
Yep.
My perspective as a real estate investor, yeah, just like Matt, it's for me, it's being able to recycle capital quickly, get into good deals, pull out the capital, hold them for the tax benefit as well. But I am all in to Jackson and low income housing, and that's the majority of my portfolio is just in Jackson alone, and I would be all in because concentration does build wealth, diversification preserves it over time. So
Mhm.
that's absolutely right. It depends on which stage and your risk tolerance. So keep that in mind when
Mhm.
making these decisions. But everyone has a little bit of their own philosophy and some things that work for them.
Yep, for sure. All right. That's it, gang.
So Tim, to next week, I'll do a full. I'll come in the first part of the session. Next week's going to be about the different tax strategies and how holding real estate can reduce your tax burden. And we'll go through the examples. 1099 if you guys are earning money through a 1099 employment. If it's W-2, if your spouse works or you don't work, or if you're a business owner. Like we'll go through all the different qualifications. We'll go through how it affects and like how you can reduce your tax bill to zero, which we'll cover next week. So yeah, stay tuned for that, everyone. We'll cover that. I'll be the first part of next week's session. To answer those tax questions, and we'll save it as probably one of the training videos as well on school.
Thank you so much.
Yep. Glad you guys are learning, and Matt, you've done a great job. I appreciate all the slides. Very informative. A lot more concepts that we should dive into, like the buyer carrybacks, buying properties turnkey with no money down, basically, like no money locked into the deal, which is something we're going to start presenting to a lot of you new investors here and existing investors within GWP. So yeah, a lot of good stuff happening.
All right. Well, thank you guys so much for hopping on today. And I'll be around for a little bit longer. If you guys want to reach out to anyone of our group, if you guys want to reach out to me specifically, I'm always here for you guys. But again, I appreciate you all hopping on.
Yeah, we have underwriters do the session, but it seems like you guys are really loving Matt. Well, I'll bring on our underwriters and guests in these sessions. But I mean, Matt, like I think everybody's loving your explanations. You're very clear. You got the slides ready. Everybody's engaging, and yeah, we appreciate everything that you're doing, G.
Good.
Thank you.
Awesome. Sounds good. Yeah.
That team. I don't think any other questions are here. So see you guys all next week. And enjoy the rest of the week. And see you all next week to talk about taxes, how to reduce them, and how to scale. Keep talking about some deals and different strategies that we have as well.
All right, gang.
Speak to you guys soon.
Have a good night,
Thank
everyone.
you.
Good night, everyone.
Good night.